Josh from the University of Verne Small Business Development Center, and here at the SBDC we help small businesses start and grow with free one-on-one consulting and free video resources just like this one. And don't forget to check out the cards above and the companion article below for all links and resources in this video. An income statement is the first financial statement that most business owners become accustomed to because it's the easiest to interpret. Yet many of our clients just starting out are unsure of how any of this financial stuff actually works. In this video, I'll break down what an income statement is, its major components, and some useful formulas to better understand your business profitability. So an income statement is a financial statement that shows how profitable a business is at a certain point in time. The income statement is also known as a profit and loss statement, or a P&L, to show how the business is making money on the job, month, or year. The major components of the income statement include sources of income, expenses, and the net income or net profit to show how profitable the business is. Now, the income statement is helpful because it itemizes expenses incurred by operations. All of these costs have a definitive number, and the business owner can pinpoint where they can increase their margin and profitability. So the major components of income statement are naturally income in the form of sales revenue, operating expenses, and finally the net income. So let's take a look at each one. So sales revenue is the primary number in this section, which can be a single component listed as sales or broken down into types of products or divisions depending on the level of detail you need. So this section can account for non-operating revenue, which could be interest or rent from a property that might not be the primary part of your business. This could include gains from one-time sales of property or equipment that can be accounted for here as well. Cost of goods sold, which is here, can account for any labor and materials in direct relation to the manufacturing of a product or a particular service for a client. These are deductions from the sales or gross revenue into what's called gross profit. Expenses are broken down into a few different categories as you account for them on the statement. Primary activity expenses are your standard business utilities, rents, cost of goods sold that are associated with the products or selling services. These expenses can also include wages to employees, commissions, and depreciation or amortization. So there are a few secondary expenses that may include paying interest that's not related to your core business activities. Losses are the final thing that you may be accounting for, such as a judgment in a lawsuit or the loss of a sale on some equipment, just to name a few. Net income is the final calculation at the end of the income statement. This shows you the profitability of operations for a given point in time. Now, what you need to understand about net income is that it's not necessarily accurate. Some figures only exist in accounting and may not translate into tangible dollars, something like depreciation or amortization. So tracking your expenses and determining your net income isn't the only thing the income statement is good for. There are a few more calculations that you can use to measure your business's profitability that I'll cover right now. So there are a few profit margin calculations that you can use to measure the profit relative to your top line sales revenue using this basic formula, which is sales minus expenses divided by revenue times 100, which is 41.7%. So if you want to compare revenue with your variable costs or costs related to production or selling instead of cost of goods sold, then you may want to use the gross profit margin formula. Now this one is a little bit more involved, where gross profit equals revenue minus direct materials, labor, and overhead. Then we get to net sales, which equals revenue minus cost of sales returns, allowances, and discounts. And then the gross profit margin equals gross profit divided by net sales times 100, where gross profit equals revenue minus our direct materials, labor, and overhead, in which case we already have this calculated as our cost of goods sold, which equals $200,000. When we get to net sales, this equals revenue minus cost of sales, returns, allowances, and discounts. We take our net sales, which equals revenue minus cost of sales returns, allowances, and discounts, which we don't have any in our example income statement, so we just use the net sales as $1 million. And finally, for our gross profit margin calculation, the gross profit margin equals our gross profit divided by the net sales because we don't have any allowances, and that equals out to our 80%. So our operating profit margin formula accounts for cost of goods sold, selling, and admin expenses. If you're working with a business that does a lot of purchasing and selling of inventory, like a retail business, then you can use this formula. Cost of goods sold equals the beginning inventory, say at the beginning of the month, what you purchase to replenish that inventory, and then minus the actual ending inventory, say at the end of the month, is revenues plus cost of goods sold minus your selling and administrative expenses divided by your revenue times 100, which gives us an operating profit margin of 84.23%. So net profit margin is the percentage of the business revenue after deducting all expenses. So net profit margin equals total revenue minus your cost of goods sold, depreciation and amortization, expenses, taxes, and other expenses. And when we do all of those calculations, it's going to be net profit divided by total revenue times 100, which gives us 19.71%. So all of these margin formulas are helpful, but you need to be careful as they aren't all equal for all industries. Different businesses can operate on different margins, but still be profitable, like restaurants, which only operate at about a 3 to 5% margin. This means you should reference the industry averages to match your business to see how your particular business is doing. EBITDA, also known as earnings before interest, taxes, depreciation, and amortization, is a measurement of a company's overall profitability instead of net income. Now, this is because all of these components are added back, which could skew net income lower. So EBITDA equals net income plus interest, tax, depreciation, and amortization, which in our example would come out to $462,000. Now, EBITDA is used by bankers to determine the debt service coverage ratio for business loans or as a yardstick for corporate restructuring. A debt service coverage ratio of 1 means that the company is operating enough income to pay a proposed debt. So to figure out debt service coverage ratio is going to be net income plus interest, tax, depreciation, and amortization, or EBITDA, then divided by your interest expense and the principal payment for your particular loan. In this case, for our proposed example, it's going to be 1.9. So as I mentioned before, the income statement may not report true costs like depreciation or amortization that translate into real-world dollars. You should definitely work with an accounting program or a CPA to set up your accounts to generate the document wherever and whenever you need it. But let me know what you think. Do you use the income statement regularly to see the profitability for your business? Let me know down in the comments below. So if you found this video helpful, leave us a like, share, and subscribe to the channel. And don't forget to hit that notification bell to get updates on all of our newest videos when they get published. Are you looking for help with measuring the financial health of your business? Check out our interview with Professor Hassey on performing a financial checkup for your business here. Thanks for watching, and I'll see you in the next video.